Welcome back. One item that seems to be on President Trump's mind when it comes to tariffs in Canada is dairy. There's a good reason. Here's a look at Canada's supply management system by the numbers. Supply managed industries include poultry, eggs, and dairy. They have a centrally set amount of production at a set price. In 2017, there were 15,388 quota holders in Canada, or producers with the right to sell into these markets. While the quotas used to be free, they've gained a market value. By 2017, they were worth $36.9 billion across the country, with some of the quotas doubling in value over the previous 10 years. Most quota holders are in Ontario and Quebec, and quotas can be a sizable part of a farmer's asset. In Quebec, a dairy farm with 64 cows had a quota in 2017 worth more than $1.5 million. Price controls at home are one side of the supply management equation. The other is import controls. High tariffs keep competing products out of Canada. Tariffs in 2018 on butter were almost 300%. Cheese and chicken tariffs were above 250%, effectively barring imports. Supply management has taken a beating in recent trade negotiations. Canada's free trade agreement with the EU, or CETA, included a deal to up the amount of cheese imported to 17,700 tons. The renegotiated North American free trade deal allowed for higher imports from the U.S. in year 6, or 2 years from now. Other agricultural products in Canada have marketing boards that help sell and price their products, but don't limit production in the same way. That includes wheat and other grains, hogs, and some fruits and vegetables. Supply management is one of the few things all political parties seem to agree on, though. Is it serving Canadian consumers well? Sylvain Charlebois is Senior Director of the Agri-Food Analytics Lab at Dalhousie University. Sylvain, thanks for being with me.
My pleasure.
So this, I called it a sacred cow earlier. There is no question about it, politically speaking. This is not one that our parliamentarians want to touch. We've seen it time and again. All parties line up to protect supply management. Is that because it's a great thing for the country and we should leave it alone?
Well, it was designed back in 1972, and things have changed since, a lot of it. And it has become political because most quotas are actually in central Canada. Half of the farms, dairy farms, are in Quebec. And I do want to separate eggs and poultry from dairy. Dairy is 80% of supply management from a cash receipt perspective. The poultry and egg industry are much more vertically integrated, so it's very different. They're much more competitive, but dairy is not competitive, and industrial milk prices in Canada are the highest in the world. So if you're processing cheese, making yogurt in Canada, you know you're paying a lot, and that's making the entire dairy sector less competitive, and it's becoming a problem.
So we know that this is on the mind of the president. Dairy in particular is in his sights, so we may have to do some negotiating. Other jurisdictions, and I'm thinking of New Zealand and Australia, have moved away over time from a former supply management system to a more market-oriented one. It's doable, Sylvain. Is that a model for Canada? Is there a path that we could lay out for our dairy farmers that gets them where they need to be?
The common denominator for all countries that have actually gone through a change, ending supply management, so New Zealand, Korea, Australia, UK, and so on and so forth. I was in Europe in 2015 for the end of supply management there. They all faced one thing, a crisis. Without a crisis, good luck, Amanda, finding one dairy farmer who's against supply management. They're all for it. They're actually very happy, and they want to hold on to their quotas as much as possible. So we need to figure out a Canadian formula, a Canadian way to make things better. But right now we have one menace that we're confronting right now, and that menace is Donald Trump. He wants to disrupt trades, and he's going to be looking for gains, and the one gain that is obvious to a lot of people is market access for dairy, in particular in Canada.
Even if we agree, and a lot of economists do, that supply management should probably be phased out, farmers compensated, and a new mechanism put in place, is now the wrong time to do it, given the very threat you're describing? In other words, do we open up our market to an unfair trading partner, if we want to call it what it is?
There are two quick fixes, Amanda. One, you buy them out. So you write a check of $26, $27 billion to farmers. Or two, you harmonize the allocation process for quotas federally. But if you do that, of course, you know what's going to happen to quota values in Quebec. So if you allow, say, people in Ontario to buy quotas in Quebec, because that's not allowed right now, which is why we're talking a lot about interprovincial trade barriers. And I've always said, if you really are serious about eliminating barriers, you have to look at supply management, because these provincial boards have a lot of power. But if you harmonize the allocation of quotas, you're going to see some provinces gain, and I would guess Alberta and Ontario, and some provinces lose big time, and Quebec would be on top of the list.
Making it politically difficult, in other words.
Oh, absolutely. And that's why, and they know that. And so I think there's probably a third option, is to open up the market and create a new set of quotas for export markets. But you need the approval of the WTO and so on and so forth. It's a longer game. But I think we're due for reform. The problem, Amanda, is that the dairy sector is not even interested in entertaining any sort of options to make the sector more competitive.
Sylvain, always good to talk to you. Appreciate your time.
Take care.
Sylvain Charlebois is Senior Director of the Agri-Food Analytics Lab at Dalhousie University. Canada has dozens of trade agreements around the world, and businesses have known for some time that diversifying is a good idea. So what stops us? Todd Winterhalt, the Senior VP of International Markets at EDC. Thanks for being with us, Todd.
Nice to be here.
So what, in your view, are the major impediments to just doing more, not even talking new trade agreements, with the ones we already have?
Yeah, it's a great question. I think there's a lot of reluctance to look beyond the immediate. And so with a market like the U.S. immediately to the south, we've been able to rely on that one destination for many, many years. And so the companies we talk to often reflect back to us that it's kind of the 3 R's. It's the relationships, the new ones that need to be built, supply chains, buyers, and then those relationships in a different market, perhaps with a different culture or language. It's the requirements, so the regulatory environment that they need to explore, taxation systems, customs, duties, things of that nature. And then finally, the big one is the resources. So do they have the right human resources, the skill set to move into a brand new market, as well as then the financial resources to do so?
And obviously, agencies like yours are designed to help facilitate all of that. What more can you do? I mean, a certain amount of this, Todd, has to do with entrepreneurs in Canada, business owners who want to explore these markets. Are we seeing enough of a shift that then businesses like yours can get to work to help them?
Yeah, Amanda, I think it is starting. And unfortunately, it's maybe taken a moment like this one to really kind of push us over the edge. We've been talking about diversification for decades, and I think we're finally there. And so it starts with intelligence, right? The intelligence of the market and of those relationships I was referring to. Mm-hmm. And there's plenty of support in Canada. So whether that's Export Development Canada, we have 26 international representations that we can draw on that on-the-ground intel and share it with Canadian exporters, or the Trade Commissioner Service, Chambers of Commerce, industry associations. That kind of information and intelligence is where we can start. And then I think we quickly move into the kind of financial supports that are available. So things like credits insurance that EDC offers, so we can insure against non-payment of a foreign buyer for a Canadian exporter who's maybe a little leery about that first step to a market other than the United States. Or even looking beyond that, ready to make that first big investment, maybe in foreign production. EDC can help there with things like foreign exchange guarantees or working capital support to free up kind of cash flows to allow them to take that first plunge.
No matter what happens, it feels like this is a good path to go down. Do you worry at all that we'll fall back into complacency and lose the sense of urgency?
I really hope not, Amanda. I mean, I think it's like your own investment portfolio. You wouldn't have all of your savings in one asset or one asset class. And so I think as we start to explore a little bit more and really ramp up the level of diversification, companies are going to see the benefits that accrue to them. So it's about, being much more resilient in the face of economic challenge, mm-hmm. the amount of opportunity and growth that's just possible in looking beyond the US or beyond traditional markets really is worth the investment. And I think we'll see that and continue to move in that direction in the future.
Todd, so good to have you for this. Really appreciate your time.
Anytime, my pleasure.
Todd Winterhalt, the Senior VP of International Markets at EDC. Coming up, an historic payout by Big Tobacco is on the way, but does it do enough? That's still ahead. But first, a lot of Donald Trump's executive orders are killing things in an arbitrary fashion, but the one that killed the minting of the U.S. penny stands out for its reasonability. Manufacturing the next to useless coin costs more than its face value. We careful Canucks killed our pennies long ago. It may not be long before we stop nickel and diming each other, too. It all just makes good sense. We're back after this.